Hi, I'm Joe Zidle, Chief Investment Strategist at Blackstone, and welcome to our Q3 webinar, The Case Against the Melt Up or Meltdown. I'm joined, of course, by Byron Wien, Vice Chairman of Private Wealth Solutions and Investment Strategist. Welcome, Byron. Over the course of this webcast, Byron and I will take you through our views on global markets in the third quarter. We'll also leave plenty of time for your questions. With that, thank you for joining us. I guess to get started, we would highlight the following few points. First, we still don't see recession in the U.S. anywhere in sight. Now, the recent developments such as the intensified and multilateral trade war have called into question the length of this economic cycle. But even so, the excesses are notably absent and business and consumer confidence remain high. And more importantly, from our perspective, the indicators that we watch for signs of recession are mixed, but leading us to believe that a recession is not anywhere imminent. And we'll show that in a minute or two. The self-inflicted wounds are probably the biggest risk at this point, and specifically, it is trade. We believe that there's a lot to be gained from a fair global trade regime, but a haphazard trade war is proving damaging to business confidence and supply chains. Lastly, over the course of the webinar, we're going to lay out the case to stay the course. And despite these risks, our case remains that trade will be resolved early next year as Trump gears up for a 2020 election. And while markets are unlikely to make much more progress in 2019, this bull market is not anywhere near ending. So for that, we remain bullish on growth prospects over the long term. This economic cycle might be the longest in history, but it's certainly not done yet. So one of the questions we get a lot is, with a record-long economic cycle, what are the signs that we're watching that are going to indicate that this expansion could be near ending? So we decided to publish this table of leading indicators, primary indicators that we're looking at that would help us to understand when we might be nearing the end of the economic expansion, and then a number of secondary indicators. These are not necessarily the best indicators to help you understand when a recession might be triggered, but rather these are preconditions for the sort of things that we would need to see for the next recession. So as we look at the top three primary indicators, our favorites being average hourly earnings, leading economic indicators, and the yield curve, what we'll highlight here is that these conditions are just not really present today. Yes, leading indicators have started to roll over, which is a warning sign, but average hourly earnings growth and the yield curve remains relatively healthy. Now, a lot of people have focused on the inversion in the 10-year to 3-month spread, and we would note that it has inverted by a significant amount and for a significant period of time. That's a warning sign. But the 10s, 2s is by far the stronger part of the yield curve. It has a better track record or more predictive powers when looking at its ability to forecast recessions, and that's still upwardly sloping. So among our primary indicators, we say that the conditions are still relatively healthy. Now, the secondary indicators are things like sentiment, unemployment, and corporate profits. And what we show here is that conditions are here a little bit mixed, but in the current scenario tells us that these preconditions are still not all that bad. So our conclusion is that this economic cycle at 121 months and counting can continue on for a long time. Growth may not be strong. We might muddle through with 2% or so growth, but the point is we're not nearing the end of the economic cycle. So over the course of this webcast, we're going to just highlight our 10 surprises, make the case for the U.S. muddling through economic growth. We'll spend some time looking at global growth before moving on to financial markets and some other considerations. So with that, let's get started. And Byron, I'd ask you to provide just an update to the 10 surprises.
Okay. Well, it's turning out to be a pretty good year. We thought that the Fed would stop raising the federal funds rate. We didn't think they would lower rates, and now it looks like they'll lower them by a quarter of a point very soon, and maybe more than that. I don't know if that's going to be the right thing to do from a policy standpoint, but the market likes it when the Fed is lowering rates, and Donald Trump really likes it. We thought the market would be up 15% this year on the S&P 500. It's already up 19%, and so we're having a pretty good year there. Capital spending and housing are only making modest gains. We're right on that one. Gold is doing better than we expected. The emerging markets are doing somewhat better, primarily because the dollar is stabilizing. March 29th came and went, and there's no deal on Brexit. I would say, based on my trip and your trip, the drift in the UK right now is to a harder Brexit than we thought at the last quarter. Here the dollar is stabilizing. The Mueller investigation didn't turn up anything cataclysmic. Congress, I think, will get more done than expected, primarily on immigration and on getting something done on the health care. And finally, we're still growth stock investors. We think that the S&P 500 is only going to have modest earnings growth, but there are a number of companies where growth will be better than 15%. On our asset allocation, we haven't done much here. We still have 5% in global multinationals, 15% in other U.S. stocks. That's 20, only 5% in Europe, 10% in the emerging markets at 35, and 5% in Japan, we're at 40, then 30% in alternatives, 10 each in real estate, private equity, and hedge funds, nothing in gold, and 5% directly in natural resources and agricultural commodities. And this is the radical part of it. We have 15% in fixed income, but not in conventional fixed income. No treasuries, no British gilts, no German bunds. This is mortgages, leverage loans, emerging market debt, some mezzanine financing, and finally 10% in cash. So that's the portfolio. When we came out with it several years ago, and we've made some changes in it, we said there's no portfolio in the world that looks like it, but we've moved some sovereign wealth funds in this direction. At the beginning of the year, we had a perfect set of conditions for the market to do well. Sentiment was very pessimistic, and as you see here, the crowd sentiment poll done by Ned Davis was only at 44% optimistic, and now it's 66%. So that's one of the reasons we believe the market won't do much between now and the end of the year. Sentiment is more optimistic, and valuations are not as attractive as they were at the beginning of the year.
Well, let's turn to some charts on economic growth. And first one that we're going to look at is another chart from Ned Davis Research. And this is one that we've been publishing now for a few quarters. And what I would point your attention to is the second and third bars here, which is looking at productivity growth and then labor force growth. And the reason why we want to highlight these is to make the point that growth over the long term for any economy is really just the combination of productivity growth and labor force growth. And what you can see is in the United States from the late 1950s until about 2008, the average for productivity growth was a little over 2%, and for population growth, it was about 1.5%. You put them together and you had about 3.5% growth, plus or minus. I think over that period, the U.S. economy actually averaged about 3.1% growth. So you can see if you add up the two, productivity and population, you get growth. Currently, both numbers are running below average, where you've got population growth just a little under 1%, and you've got productivity growth running just above 0.5%. And so basically what it would argue is that for the United States, a mature economy, we should really only expect 2% growth or so. Now, that said, we are going to have many booms and busts, and this chart looks at leading economic indicators. And what we'd highlight here is that we do think that we're near a bottom on the LEIs, and you can see the relationship between the LEIs and GDP growth. Leading indicators, they obviously lead by usually 6 months. Some people will lead them by up to 12 months, which we've done here in this chart. And what it argues is that growth should fall in 2019, which is what we're expecting. But then we do see reasons to be optimistic because we think LEIs will pick up into 2020, which would be bullish for growth.
Okay, so let's take a look at productivity growth. In the first quarter of this year, productivity was up 2.4%. That argues for stronger growth later on this year or the beginning of next year. Donald Trump will be delighted to hear that because that'll mean that the economy has a pretty good chance of picking up steam during an election year. Consumer income and expenditures are in an upward trend, but probably the most favorable thing is that household debt payments are really down a lot. So the consumer is in good shape. The consumer is 71% of the U.S. economy, and the consumer is the driver here, and we can count on the consumer to do their thing.
These couple slides are going to look at consumer and business confidence. And what you can see here on the left-hand side is that consumer confidence is elevated, and typically it is going to fall before recessions. On the right-hand side is business confidence, where we're looking at CEO confidence in the blue line and small business optimism in the green line. Both of those remain elevated as well. Again, that is positive for economic growth. This chart is one that we would put in the warning category, and this is looking at consumer confidence expectations minus the present situation. So in other words, what this indicates here, when the line goes below zero, that people are feeling pretty good about the present situation, but are worried about the future. Now, I call this chart a warning because the one trick to understanding this chart is we don't actually know when this line is going to bottom. But what we've highlighted here is the bottoms tend to occur just prior to recessions. Now, we don't know how much lower the line is going to go, but again, it's something that we would be putting in that warning category, although there isn't a hard, fast number that says at a certain level, below 50% or below 75, it would trigger a recession warning. Now, this chart looks at small business optimism. And this is an important one because small businesses end up employing about 50% of the private workforce in the United States. And you can see that small business optimism really increased after the election in 2016 and has remained elevated. This chart is another look at small business optimism, and it's looking at small business sales expectations. And what we've done here is we've combined it with nominal GDP growth. And you can see they've got a pretty strong relationship. There's an R-squared of almost 0.5 between small business sales expectations and GDP growth. And the reason makes sense because as small business confidence goes, so goes the economy. When small businesses are expecting higher sales, they are deploying CapEx and they're hiring people. Now, this chart looks at wage growth, and we think it's going to continue to rise. And what the chart looks at is average hourly earnings growth and jobless claims, where we invert the jobless claims. And you can see this gap here between the two indicates that average hourly earnings ought to be moving higher. Now, one of the reasons why average hourly earnings has been somewhat restrained over the course of the last couple of years is because we've had a lot of entrants coming in from the bench, coming off the bench, so to speak. In other words, they're out of the existing labor pool, but they're coming in and they're finding jobs. Now, typically, people who are out of the workforce are defined as being either students or retirees or disabled or people who are staying at home because of certain home responsibilities. And the number of those people who are coming into the workforce today is hitting a cyclical high. And a lot of these new entrants to the workforce are simply happy to have jobs as opposed to pushing for higher wages. So as a result, there's still this reserve pool that's going to continue moving into the workforce, which means average hourly earnings might remain somewhat restrained, but generally we think they're going to be moving higher. Now, what this chart looks at is core inflation. It's rising, but not nearly high enough or fast enough to be concerning. And the lines we're highlighting here are non-manufacturing operating rate and core CPI. And you can see there's a pretty strong correlation between the two. It's just over 0.5. And as the non-manufacturing operating rate increases, it argues that core CPI ought to be moving higher as well. The non-manufacturing operating side of the economy is the lion's share of the U.S. economy. Manufacturing only accounts for about 11% of total GDP. So what we're talking about here is the other 89%. And you can see that as it tends to move higher, that CPI will generally follow. Now, of course, we know that CPI and the PCE deflator have been struggling to live up to the 2% target that the Fed has, and we think it will continue to struggle. But nevertheless, there are some signs that inflationary pressures aren't as weak as the market expects. And remember, because the market views inflation as being so weak, it's really what they've done, what they're using to push the Fed to upwards of 3 rate cuts in 2019. So what this chart looks at is the typical relationship between the markets and the Fed at surrounding their first rate cut. And what the blue line highlights is in the 12 and 6 months leading up to the first Fed cut, equities are generally pretty flat and then really take off. But in this cycle, the market's already priced in a lot of the Fed's activities, with the last 6 months equities being up around 20%. It's one of the reasons why we argue that gains from here are going to be pretty limited. In other words, the market's already priced in 75 basis points worth of cuts. I think there's only room for disappointment. So let's turn to global growth here. And we would argue it's being tested. And what this chart looks at on the left-hand side is IMF adjustments to their growth forecast from October of last year to April. And what you can see is that they've taken down world growth, and that both of advanced and developing economies. On the right-hand side, you can see that world growth is going to pick up again in 2020, but it's really going to be driven by emerging markets, and it's principally just India and China that are doing it. But you can see the advanced economies are going to continue to slow. In 2019, the IMF figures that the advanced economies are going to grow around 2%, while EM grows at about 4.5%. And for 2020, that growth is going to slow in the developed world to about 1.7%. Principally because of weakness in Europe and Japan, whereas I think the US will continue to do okay, but you see EM is going to accelerate. And digging into that growth a little bit more, what you can see is that emerging market economies contribute about 75% of incremental global growth, and China is about half that, and the rest of the emerging markets are the other half, whereas the US and other countries are relatively small contributors. So what happens in the US, in China, in India, and the other emerging markets is really going to be critically important to the global growth story. Now, looking at Europe, we think there's some signs of stabilization where we're seeing GDP growth stabilizing and LEIs beginning to stabilize. Now, unfortunately for Europe, a lot of these leading indicators are stabilizing, but in contractionary levels. And there's a pretty good chance that in 2019, Germany, France, and the UK could join Italy in recessionary conditions. Nevertheless, there's some stabilization, and there's the prospects of a new head of the ECB, which we'll talk about in a little while, that will maintain some pretty dovish policies that should put a floor on European growth. Now, what this chart highlights is that central banks are, again, easing monetary policy, and this is supportive of future growth. And this is something that we talked about in our year ahead in the 10 surprises, that central banks would move toward the tightening of 2018, where 56% of central banks hiked rates, to easing in 2019 and beyond. And what this chart highlights is that central bank balance sheets have probably troughed this year and will begin to expand. And Byron, I'll turn it over to you for a couple slides on trade and GDP.
Okay, well, trade is very important, and you can see all the key countries where the trade is really going to make a difference. This is the percentage of trade items at various countries. You can see it's close to 40% in China and India, and it's more than that in Europe and Latin America and Mexico. So trade is an important issue, and it's important, really key to get that resolved, particularly with China before the end of the year. And you can see that it's going to play a role in the election. You can see all the states that do significant trade with China. And it's not only on the West Coast where you'd expect it, but on the East Coast as well. And Mexico is important also, and we're not developing harmonious relationships with Mexico or Canada. So we've got to get this trade issue resolved and moving forward, and it's not really making progress right now, in spite of the fact that it's billed as such.
Yeah, and I mentioned multilateral trade issues because I don't think we should take the Mexico tariffs completely off the table. And of course, President Trump has talked about his desire to go after the Europeans on autos and other trade issues. So I think there still is some global trade risk out there, whereas the market seems to be pricing in, I would say, a quick resolution on China trade and really ignoring the prospects of both Europe and Mexican trade issues. Now, what this chart looks at is the impact of trade growth on GDP. And on the left-hand side, you can see that trade growth is contracting. World trade's going to fall by about 2% when you look at current tariffs. which is the bottom part of the bar, the tariffs potentially being extended to the rest of US and China trade, and then also just a higher global risk premia. And what you can see on the right-hand side is that it does impact China's growth the most. China GDP would be hit by a little over 1.2% should those three come to fruition. But the U.S. does not escape unscathed either, where we could see almost a percentage point lower in growth, nor does the global economy escape either with about a 0.8% reduction in growth should all three come to pass. So the point here is that the United States and the U.S. and China need to reach an agreement. China needs it economically, and I think the U.S. needs it politically. But we don't think it's going to happen anytime soon. So what this table looks at is tariffs. Now, the prior rounds of tariffs didn't really have a lot of impact at the consumer level, right? What you saw in 2018 were tariffs against pretty thinly traded items. Yes, you had tariffs against steel and aluminum that were pretty narrowly focused, but the rest of the tariffs included things against imported nuclear reactors or isotopic separator machines. I don't even really know what an isotopic separator machine is, but when I searched on it on Amazon, it probably cost me my TSA pre-check. But what this table looks at is that next round of tariffs if it were implemented. And what we're looking at here is just the top two categories of mobile phones and laptop computers, where the U.S. imports about $45 billion and $37 billion worth of them, respectively. Now, that would result in about a $20.5 billion price increase in phones and laptops, assuming the 25% tariff rate. And that is over $620 per American, assuming 10% of the population purchases a new phone or laptop per year. Now, the other effect that trade is going to have is on capital spending. And what we know is that businesses are feeling the heat too. And this is looking at CapEx plans for businesses. And you can see in 2019, CapEx plans have been roughly cut in half. Uncertainty is the enemy of growth, and that's what we see depicted on this chart.
Okay, let's take a look at the financial markets. We've been in a period of very strong earnings growth, and that's not going to be the case this year. For calendar year, we're looking for earnings growth for the S&P 500 somewhere between 2 and 3%. And that's why we're stressing growth stocks where the earnings growth can be 15%. And we don't think that's reflected in the multiples. The strong dollar is putting some pressure on the emerging markets, but we think the dollar is going to stabilize from here, and that's why we have a healthy allocation to emerging markets, particularly India and China.
So this chart's looking at the global negative yielding debt, and you can see it's reapproaching historic highs. On the left-hand side, you see a little over $12 trillion of debt globally is now at negative yields. On the right-hand side, you can see that about 75% of the $38 trillion of outstanding debt is yielding less than 2%. In other words, yielding less than treasuries. And households are about the only category that are increasing their holdings of treasuries. So we know we've got the potential for a supply-demand mismatch here, because we know on the supply side that the U.S. has to issue about $1 trillion worth of debt in 2019 and another $1 trillion worth of debt in 2020, just for the heck of it. And what this chart looks at on the right-hand side is the major purchasers. And as you can see, households have taken up their holdings of treasuries over the last couple of years, while the Federal Reserve has taken theirs down through shrinking their balance sheet, and foreign holders have roughly remained flat. Now, a lot of the argument goes like this. With so much negative yielding debt around the world, foreigners should be coming into the U.S. and buying our debt simply because it's yielding more. The challenge is that's not in the data. And that's what we're really highlighting here on this chart, that foreigners haven't really increased their holdings because for a foreigner, someone sitting in Europe or Japan, in order for them to buy U.S. debt and hedge out the currency risk, it ends up being very expensive. To hedge out the currency risk on a 10-year treasury, if you're a European, could cost somewhere around 300 basis points per annum, according to the last time we ran the data. So what this pie chart looks at here is the largest holders of treasury debt. And you can see Social Security is at $2.9 trillion, Well, Social Security Trust Fund is going to be flipping to a deficit beginning sometime in 2020, which means they're not necessarily going to be purchasing more. The Federal Reserve has been shrinking its balance sheet. China's holdings of treasuries peaked at about 1.3 trillion a couple years ago. It's not that they're actively selling treasuries. It's simply that with the trade tensions, the trade between the U.S. and China has contracted. It's down about 15% year over year. So in other words, as China's trading less with the United States, they're naturally buying less treasuries. Japan's been keeping their treasuries holding steady at about $1 trillion. So in other words, the big four haven't necessarily increased their holdings, and in some cases are actually reducing their holdings, which means you've got to turn to the UK, Brazil, and Ireland as your next three biggest holders of treasury debt. And with $1 trillion of new supply coming in 2019 and 2020, it's not as if they're going to be able to step up to be the incremental buyer. Now, that said, supply and demand ends up being a horrible way to forecast yields. I've personally been wrong on the direction of the 10-year treasury all year. Nevertheless, this does not help when you think about the amount of supply that we have coming. Byron, I'll turn to you for the dividend discount model.
Okay. Well, we believe that stocks compete with bonds, and this model shows how that relationship works. If you know two variables, what the yield is on the 10-year treasury and what the S&P 500 is going to earn, I can tell you the equilibrium point where stocks and bonds are equally attractive. At the beginning of the year, we were using 170 for S&P earnings. We're now down to 166. The 10-year treasury was around 2.5, but now it's hovering around 2. And if you look at 166 and 2, you can see an equilibrium point of 33.01, and the market is pretty near 3,000. So there's still some upside left in the market. But we think that interest rates could be rising here, and on that basis, the model changes pretty quickly. At 2.5% and 166, the equilibrium point is 2,500, and we think there's a possibility of that. And so this model makes us think if we're in a rising interest rate environment, there's a strong possibility the market doesn't make much progress between now and the end of the year.
So before we move to questions, we're going to hit on a couple other trends that we think are interesting and worth highlighting here. And the first is looking at new homes. And we think that the housing cycle is going to pick up. And what this chart highlights here is single-family homes sold with the scale on the left-hand side versus 30-year fixed mortgage rates. And the gap between the two has never been larger in the history of the data. And with mortgage rates being so low, we think housing activity is going to pick up. Now, there's a lot of arguments that say, well, millennials are forming households at later ages, or some people just like living at home more. Maybe we're moving closer to the Italian model where something like 65% of all young adults live at home, compared to, say, 31% for young adults currently in the United States. I don't know. I hope my kids don't get that data. But the point is, we think that we will see some new household formation. This argues that home sales should be picking up. This chart highlights the rental and homeowner vacancy rates. And I think this is an important one for the following reason. The market has been concerned that inflation is too low. When you look at CPI and strip out the two most volatile components of it, which are food and energy, you get to core CPI. And in the formula for core CPI, shelter, which is rental or homeowner or homes, single-family homes, ends up being about 60% of the weight of core CPI. Now, what this chart highlights here is that the vacancy rates between rentals and single-family homes is basically at the lowest levels that we've seen since the 80s or 90s. And that means you should see upward pressure on rates for rentals, et cetera. Now, what this scatter plot shows is just the relationship between the growth of shelter costs and the vacancy rates. And basically where we are today in the first quarter of 2019 with a vacancy rate below 7%, it argues that shelter costs or rent should be going up somewhere around 5%. So in other words, the biggest part of your core CPI we think is poised to move higher. Byron, over to you for some charts on healthcare.
Okay, well, this is not good news. Well, we're spending more money than almost every other country in the world, and we have less to show for it, at least in terms of longevity. The average lifespan in the U.S. is about 78 years. People in Europe and Japan live longer and spend less money on health care. And we think health care is going to be a big issue in the election. You're going to have a number of Democrats arguing for universal health care, arguing that you can get better care at lower cost if you go that route. You're also going to hear a lot about inequality and how the Trump tax plan has benefited the wealthy in this country and not the average person. The clarion cry of the Democratic Party is that the economy is doing better, but not for the average person. And this shows that in 1965, the average CEO made 20 times what the workers in his plant or company made, and now it's up to 300 times. And it's been rising steadily in the new millennium. So the fact that the Trump tax plan benefited the rich, didn't benefit the average person, is going to be a key issue in the election. And what this shows is that we better count on immigration. With immigration, the working age population will increase from 173 million to 183 million in the 2015 to 2035 period. Without immigration, it'll drop from 173 to 166. And if you go back to what Joe said earlier, which is that GDP growth is the sum of productivity and population growth. If we have a shrinking population, it's going to be tough to have rising GDP. And you can see something interesting about the net change in the working age population. Look at these various bars. We really need immigrants. Immigrants have been an important component of the net change in the working age population. And with the present programs in place, you can see that we're going to be more dependent on U.S.-born kids with immigrant parents, because the U.S.-born kids with U.S.-born parents is going to be shrinking. So we should relax the immigration.
Yeah, and Byron, it's worth pointing out on this chart where you're seeing that the working age population in the U.S. is only going to grow around 0.3%. On a relative basis, when you look at other developed countries, we actually have the best demographic, because what you see across Europe and Japan, our trends are even worse. So while our demographic picture is not good, it does remain best among the developed markets. And on the emerging market side, India has got the best demographic as well, versus China, which is suffering from an older population. So I think it's interesting to put this into context on a relative basis as well, because what you find is that the US and India end up being the two best relative stories out there.
Well, the real thing to look at is the expanding middle class. And the expanding middle class is heaviest in India and China.
Yeah, we got a question about that, so we'll address that in a few minutes.
Okay, so let's take a look at another issue that's going to be big in the election, and that's the environment. The point here is that the United States only accounts for about 15% of CO2 emissions. So if we do everything right, which is what a number of the candidates are pushing for, we still have the rest of the world that we need to get on our side. The 85% of the pollution is being provided outside of the United States. And probably the biggest culprit is China, but China is also doing a lot about it, but they're starting from a very low base.
Well, great. So Byron, let's turn to questions. And we did have a handful of questions that were submitted in advance. We're going to do this a little bit more of like a lightning round today, because we do have 8 or 9 questions here that we received, and we want to try to go through them in order in a reasonable amount of time. So we'll get started. And the first one that we received is on the economic expansion. The question reads, U.S. economic expansion is now the longest on record. Doesn't that alone mean that a recession is coming soon? And with yield curves inverted, how do you look at the economic cycle?
Well, I look at the economic cycle on the basis of where are the excesses. And we don't really have a lot of excesses right now. Growth is mild. This is the longest expansion, but it's also the slowest expansion. So the combination of a slow growth expansion and low inflation is what this cycle has going for it. And probably more important is if we get into a recession, we don't really have the tools to get out of it. We've already been through a strong period of monetary expansion. I don't think we want to go back to that. That's one of the ways to get out of a recession. And fiscal spending is another. And the budget deficit is already over $1 trillion a year. So I think the policymakers are going to be doing what they can to prolong the advent of the recession as long as possible. And I'm hopeful that they're going to be successful. The earliest I could see a recession is 2021, the year after the election.
Right, and it's important to point out that not all portions of the yield curve are equal. They're not all as predictive. A lot of people have been focused on the inversion between the 10-year and 3-month, which has been inverted about 6 weeks now by an average of 15 basis points. Historically, it's got to be inverted for about 10 weeks at an average of 15 basis points to produce a reliable signal. But the part of the yield curve that is far more reliable is the 10-year to 2-year, or so-called trader's curve, and that remains upwardly sloping. So the bad news when you're looking at one part of the yield curve inverted is the following, that typically when one part of the curve inverts, the rest of the curve will generally fall into line and invert at some point down the road. We're just not there yet. And generally speaking, what it takes to cause a recession, and Byron said this, it's excess. It is overinvestment by businesses, or the second thing that will generally cause a recession is wealth destruction. That's when households see the value of their homes drop, like 2007, 2008, or they see the value of their savings eroded through a giant bear market or something like that in equities.
Or they see euphoria in the stock market, which we haven't had that yet.
That's right. So the next question came in is the market is expecting the Fed to cut by 25 to 50 basis points this month and expecting 3+ cuts through the end of the year. Do you think the market is being too optimistic or maybe too dovish?
I do. I don't think the Fed is going to do that much. The economy is doing too well for them to give that much of a monetary stimulus. So my view is they'll do it. They'll definitely do one cut of 25 basis points, and they'll wait and see if the economy is able to sustain itself at a 2.5% growth rate. If we continue to grow at 2.5%, I don't think we'll have 3 rate cuts.
Yeah, and the prospects of getting an insurance cut when the S&P 500 is up 20% nearly 20% year to date. High yield and emerging market bonds are up almost 10% year to date. So the prospects of getting insurance cut with those types of conditions, I think, are pretty low. Next question is, what's the latest view on how the trade war is impacting business confidence, capital spending, and supply chains? And maybe I'll start with this because we have had a lot of talk on the trade war, and I've always argued that people looked at it a little bit too simplistically. They sort of looked at it like a game of checkers where the United States would put on a tariff, we would wait for the Chinese response, et cetera. But the argument I've always made is that trade is much more global, it's much more interconnected and much more complex. And as a result, it resembles something more like a chess match versus checkers. And in a chess match, you have far more possible combinations on a chessboard, and which invites the law of unintended consequences. And I think that's what we're seeing with trade. And we're seeing it manifest itself in a couple ways. Number one, we're starting to see companies and businesses complaining about higher input costs, and that is a result of either supply chains getting scrambled, or simply because some producers are taking advantage of the tariffs in order to justify or to increase prices. Either way, one of the big risks that companies are facing today is margin pressure, that simply their input costs are rising. And what we've heard from a lot of companies is that they're moving supply chains out of China and moving them into Vietnam, yet they're facing labor shortages in Vietnam, or they're finding that they can't get the quality or quantity that they require, or that Vietnam simply can't produce in a way that China does. So I think with the trade war, what we have to understand here is the law of unintended consequences, that we're going to see supply chains moving out of China, which is going to cause lower growth, and we're going to see delivery delays, higher input costs, and other quality-related issues that are potentially going to drive higher prices in the United States. Now, what we hear from the markets say the following, that a trade war is deflationary. Well, it's an interesting argument because for 30 years, the argument has been that globalization was deflationary, right? That we could buy our t-shirts from anywhere and thus the prices would go down. And now what we're hearing is that deglobalization, i.e. trade wars and more inward thinking and building of more walls, so to speak, is going to be deflationary. I don't understand how you can have it both ways.
Sounds like fake news to me.
So next question is, are there any geopolitical risks that investors should be considering as they're deciding to allocate their portfolios? And maybe, Byron, I'll turn that one over to you.
Oh, boy. Well, you've got the Iran situation. The Straits of Hormuz could be closed. Price of oil could soar. That's one to worry about. Relationships with Russia. Russia and China getting together to gang up on Europe and the United States. There are plenty of geopolitical risks out there, but there always are. And the market seems to have a way of muddling through. I think it's in everyone's economic self-interest to try to get along. And so we're optimistic that the market won't have a melt up, but it also won't have a meltdown because of any of these factors. Do you agree with that, Joe?
I do, and I think you're right about the market finding a way to muddle through geopolitical concerns. I run a lot of trails, and there's an expression when you're trail running that goes, "It's never the snake that you see that bites you." I just took my family over to London for a vacation, and they say in London, it's never the bus that you see that hits you. That's why they paint those little things on the side of the, on the curbs, but we still, we're Americans, so we still look the wrong way. But nevertheless, I think you're right that the market's able to discount it. The next question is, where do you see the greatest opportunity in emerging markets? And maybe I'll put India on the table for discussion because as we talked a little bit earlier, China and India are the two fastest growing of emerging markets, but the advantage that India has is it's got one of the most favorable demographics. And according to a study by the Brookings Institution, among the next billion people globally who are going to move into the middle class, India is going to be responsible for about 36% of those, exceeding even that of China. And so I think the advantage that India has is simply coming off a lower base, right? There's this theory that says it's easier for a country to go from low income to middle income than it is to go from middle income to high income. And where China is today, with a per capita income of about $8,600 per person, they're struggling to go from middle income to high income. And everybody's focused on the struggle between the US and China for global dominance. But what they're potentially missing is a country like India that's quietly moving from low income to middle income. It's much easier. They're going to end up producing a larger middle class as a result. So I think India is probably one of the biggest opportunities in emerging markets. Any reaction or thoughts to that?
Yeah, I agree with you, and we agree with you as a firm. We're seeing opportunities there in private equity and real estate. But one thing I would emphasize, probably the most preoccupying thought I have, is that China has an objective to be the global leader in politically, economically, technologically, and diplomatically by 2049, the 100th anniversary of Mao's taking over the Chinese government from Chiang Kai-shek. And I think they're on that path. So they're going to give us a run for our money competitively, and that's something we really have to work to neutralize.
So the next question, how, if at all, do you expect the change in leadership at the ECB to influence the euro area's growth and inflation trajectory?
I think Christine Lagarde is going to be dovish in her orientation, and frankly, I think that's what Europe needs. So I'm optimistic that her taking Mario Draghi's place is going to be a positive for the world economy.
Now, let's not forget, it was Draghi in 2012 that on the eve of the London Olympics at a conference in London dropped the words "whatever it takes" into a speech, and that's what really initiated the ECB cutting rates and then ultimately expanding their balance sheet. And there's the expectation that Lagarde would be dove as well. And conditions in Europe today are probably as weak, if not weaker, than they were back in 2012. So I think that's exactly what Europe needs. Europe is not necessarily a growth market, but if you do get the right central bank policies, then what you might find is value opportunities. Now, last question here, I saved this one for last. What are some areas in which your views diverge? And I think it's always healthy to have different perspectives and differing perspectives on markets. So I know one area that our views diverge is on inflation. So Byron, your views on inflation, thoughts or any reaction to that, or anything else where you do see divergent views?
Look, I think inflation is going to stay low. There are too many people out there making too much stuff. And there are too many people looking for jobs and looking and being willing to move where the jobs are. But also, I think as a result of low inflation, interest rates are going to stay low. Between 2008 and over the next decade, the central banks increased their balance sheets from $3 trillion to $16 trillion. And a lot of that additional money floating around is looking for a place to hide. And that's why interest rates have surprised everyone by staying low. So I think we're, one of the favorable background factors for the market is that inflation and interest rates are going to stay lower than expected for a prolonged period of time.
Yep. And at the same time, what we see from investor flows is that investors are overweight fixed income and they're increasingly extending duration. And as a result, the most crowded trade out there is that rates are going to stay lower for longer. And I would challenge that because we know the market's always going to do whatever it can to prove the majority wrong. And I think when you look at the components of inflation, you've got 60% of core CPI, which is shelter. And the real estate data tells us that prices ought to be headed higher. And the other 40% of core CPI are things that are going to be susceptible to higher prices due to tariffs. And in a world where we do have tariffs that linger, the data tells us that those costs are being passed on to the consumer almost on a one-for-one basis. Now, certainly 2018's tariffs were on fairly narrowly traded items. You had some tariffs on steel and aluminum, which were pretty narrowly focused. But aside from that, your tariffs are on things like imported nuclear reactors and isotopic separator machines. I don't really even know what those things are, but it's not like any of us are really waking up saying, oh my gosh, the cost of my imported nuclear reactor went up a lot today. But what we know about 2019's tariffs is that these are things that are going to impact the consumer. So I think the risk is that inflation isn't nearly as low as people think it is. And as a result, you see a 10-year Treasury hovering around 2%. I think that's a lot lower than it ought to be. So those are a couple of areas. Now, we'll end there in the interest of time, and I want to thank you, Byron, and thanks again to everyone who tuned in with us today. In closing, I'd like to remind everyone that our next webinar will be on October 10th. And lastly, if there were questions we didn't get to, or if there are other concerns or feedback, please let us know at blackstonestrategy@blackstone.com. Thanks.